I think it, to some extent, it goes back to what I was sort of describing as biases. I think if you have access to a great location, great product, you can really see, the value in the land, the optionality, a lot of features that would actually protect the long-term capital value. Then you have to go back and think about what's the required return for such an asset, for such a stream of cash flows. And in today's environment, that probably has a lot of value. So it's really about setting the required return for these assets. And I think we just have to be realistic. And that's sort of on the one hand, and there's a barbell strategy going on here about it also has there's a lot of value in creating those products. So where we think we're comfortable in building to core, where we think in those locations we can have access to an asset, we'll create a new income stream with probably a new changed use or a new tenant, either through a light refurbishment, heavy refurbishment, or complete redevelopment. Then I think we should be very happy to take those calculated risks. So I think that's one type of answer. The other type of answer goes back to the new property types. Moving into outside of the traditional property types and then sort of embracing some of the new property types. PRS is one example here in the UK. There are also student housings. We've actually went long student housing 4 or 5 years ago. And they benefited from first mover advantage. You have a yield premium, but then again, it's about the operational risks. A lot of these new property types do not have a well-established facility, property management operations, and you probably have to back up an operator to operate these assets for you and maintain those cash flows. So I think it's all about taking those risks that you feel comfortable with in this very low yield environment and making sure a client understands the types of returns they're going to get.
We've certainly seen, money that was focused on, say, Ireland moved to Spain. Now it seems to have moved to Italy. Or even further afield, we've got a deal at the moment in Croatia, for example, which is sort of hospitality related and therefore not linked specifically to the Croatian economy. But I do think that fund managers as well, or funds, are very conscious that they don't want to do a deal that, with the benefit of hindsight, was seen to be the wrong deal. They're very conscious of the impact on their further equity raising from a brand perspective. So although they're looking to do deals in Spain, Italy, etc., and there is a weight of money there with people with similar business plans, certainly the transactions that we're involved in are seen to be very thoroughly thought through from a business plan perspective. So I don't think people necessarily are just rushing to get their equity away with so many other uncertainties going on in the market at the moment.